Welcome everyone to this webinar named The Next Real Estate Cycle is Here and Why 2026 and 2027 could reward investors who move before the crowd. This is a data-driven, chart-heavy collection of eye-popping insights that'll help you make high-quality investment decisions in this challenging but very interesting and beneficial environment. And you can focus on opportunities that this commercial real estate recession has created. So everything that you're going to hear about today it's focused, it's actionable, it's tangible. There's no upsell, there's no subscription, there's no higher tier, right? We're not even necessarily looking for a call to action. This is pure content. It's for fun, it's for learning, and hopefully for some investment. For those of you that don't know Grocapitus, we are quirky and opinionated amateur data scientists and technologists who buy and build large projects. Our portfolio of 25 properties is worth about $500 million, and over 1,300 data-driven and nerdy investors have trusted us with their money. About $350 million of investor money is being used. This is about half of our portfolio. We use data science and now AI to invest in 8 different asset classes. So multifamily value add, apartment new construction, single family built to rent, fourplex built to rent, student housing, built to sell townhomes, self-storage, and flex industrial, right? So each of these asset classes taught us something different and hopefully made us better at our job, which is to protect the investment of our investors. And we've gone full cycle 9 times on these projects, with the 10th one coming up in a couple months, with an overall IRR of about 33%. So that's more than a 33% annualized return over those 9 exits. The average annualized returns are right here, 40% across those 9 exits. So great numbers, but keep in mind, let's be honest, this track record was artificially boosted by extraordinary market conditions until 2023. Future performance is likely to moderate to a more reasonable level. Here are 2 of those projects that we exited during that crazy time in 2021 and 2022 before the commercial real estate recession. So it just gives you a sense of what's possible when the market is at its peak. Real estate has a lot of potential, and this demonstrates that maximum potential. Our investors, they love what we're doing. Here is Chong. She is a super experienced investor, dozens of investments, and she compares us to much larger companies that have more projects, and she thinks that we come out ahead of them. Here is Brian. He invested in one of our projects, this one here, and where we had to navigate through the COVID pandemic, and we still doubled his investor in 4 years and also offered him a 1031 exchange option at the end. All right, folks, let's get the boring legal stuff out of the way before we dive into the good stuff. This is a friendly reminder. This webinar is for educational purposes only, and just because we're sharing our personal opinions and our research, it doesn't mean that you're guaranteed to make a fortune in real estate. So do your own research, consult professionals, and remember that investing in real estate is risky stuff. And don't be shy to type in your questions. We're going to do our best to answer all of them at the end. And don't worry if you miss anything. We will send out a recording over to you after we're done. That's probably going to be tomorrow or day after, right, Peter?
Correct.
All right, so this presentation basically talks about a reset in the commercial real estate market. You may not even be aware of this reset, by the way. When I use words like recession or reset, people are often surprised. Well, that's why we are here, to give you information that you don't have. And we start the reset by tying it to the US economy, because if the economy isn't doing well, then you might not make a lot of money in real estate. These 2 things are tied together. So let's see how we did in 2025, right? We've now gone 6 months into 2024. So 2026, there's significant upside after the reset. Our GDP annual growth is projected to be at 2%, and now that the Iran war hopefully is going to be over, we might easily hit that number. Unemployment rate is staying low. Job creation has stayed pretty strong, surprisingly strong through the first 6 months of the year. And inflation, while it's ticked up a bit, almost 100% of the inflation increase has been based on the oil and the war. And so if that settles down, we should start seeing inflation come down in Q3 and definitely by Q4. Job growth has been the problem. So it hasn't been the unemployment rate. It stayed where it is. Not a lot of people are getting unemployed, actually. But job growth has been anemic in 2025 and also at the beginning of 2026. We have these whopper IPOs coming up, SpaceX, Anthropic, OpenAI, and hopefully that will kick things into gear. We had projected 2 rate cuts for this year, but obviously that didn't happen because of the war in the first 2 quarters of this year. We still think that there's 1 rate cut coming in Q4. So the market is resetting. In 2025, basically what was the big challenge for the economy was tariffs, and you see that in the graphic on the left, where tariffs were essentially slowing the economy down, even though on the AI side, AI was boosting the economy greatly and having a phenomenal positive effect, but tariffs were slowing the economy down. We think that the downside from tariffs has pretty much ended at this point of time. Whatever one-time downside was happening has ended, and also most of the tariffs have now been ruled unconstitutional. So you see that tariff shock on the screen there. You see that big arrow with the president, Liberation Day. And so obviously global markets, took a massive shock there. And since then, primarily because of AI, we have seen an incredible growth in global markets all across the US, all across the world actually. And even with the Iran war, we have not seen any substantial impact on the world equity markets, whether it's Japan or China or India or Europe, US. All equity markets continue to move upwards in a great direction, which is very, very beneficial because real estate markets really benefit when the equity markets are doing well. And so we're doing well to absorb that policy shock. This chart actually shows the US dollar being down, but it started to tick back up. So that's in a good place. Well, I wouldn't say in a good place, but in a decent place. It absorbed the tariff shock, and you see that right here. And now we're basically beginning to move in an upward direction when it comes to the US dollar. And inflation is really no longer the main story. Inflation had dropped by December 2025 to 2.7%. As I mentioned, it ticked up because of the war, and I expect that is going to be dropping in Q3 and Q4 as long as the Strait of Hormuz opens. So we're all hopeful that happens, and we start seeing inflation go back into the 2% range where it really should be, because the economy is not likely to have a lot of inflation, and the impact of tariffs has really wound its way through 2025 and into 2026. So I expect that we'll see a better inflation picture in the second half of this year than we saw in the first half. What's interesting is, and most people don't know this because you hear only bad things on CNN or Fox News, is that the U.S. economy actually had a really good 2025. We were the fastest growing major economy in the world. So amongst the G7 economies, you can see that we crushed it amongst, and our 2026 growth predictions from Goldman Sachs, so far we're on track. So half the year has passed, and if you look on the right side in the blue box, you see Goldman Sachs predictions there. We're on track for that. I think we're gonna do those numbers, and that really helps in terms of rent growth and in terms of asset value growth. The labor market is finding some balance now. The second half of last year was very, very weak, and you can see that on the right side. But the first half of 2026, while still fairly weak, has been significantly better than the second half of 2025. I'm going to skip past this particular video and talk about the recovery process, right? Where do we see the recovery in commercial real estate and why it's beneficial potentially for investors? This is a great time to buy because the market's down. Did you know that prices in commercial real estate, especially for multifamily, are down 20 to 30%? 20 to 30% from peak. 9 out of 10 people don't even know that that's happened. So once again, I'm going to skip past this particular slide, but we are seeing definitely a normalization of the labor markets after the shock from immigration. Obviously, when we did the whole ICE thing, which was a lot of it happened in the second half of last year, there was a shock to the labor markets, right? Basically, somewhere between 500,000 and 1 million jobs disappeared because those people disappeared. And now we're seeing a normalization in the labor market happen. So that was general economics. We talked about inflation, the labor market. We talked about GDP, job growth, all of those kinds of things. That now leads us into real estate entering a new phase. And we're positioning basically a new cycle in 2026 and 2027 across single family and multifamily. I'm going to go into the Trumponomics slide, Trumponomics 3.0 is a housing shakeup. So what Trump is doing, what the Republican Party is doing, is both good for real estate and bad for real estate. So there's things that are helping us in real estate, and there are things that are not helping us. And when I say real estate, I don't mean multifamily real estate, single family, multifamily, any kind of real estate, right? Really, is being both helped and not helped by what is happening with Trumponomics. Starting with opportunity zones, right here where my cursor is, that's really amazing. What Trump has done with Opportunity Zones 2.0, this is a program that starts in 2027, is providing a massive amount of tax advantages to real estate. This is going to bring, in my mind, tens of billions of dollars into real estate because the tax benefits are incredible, and it's a 10-year benefit, huge benefit. Obviously, the Democrats didn't take away opportunity zones, when they were in power from 2020 to 2024. So this is a program that has appeal to both parties, and it is extremely, extremely strong. So it's beyond the scope of this webinar to discuss it. Let's just say that when people invest money into real estate, they get huge tax benefits, and those tax benefits are for 10 years or more. The ICE implementation has led to labor shortages, which is basically making it harder to build new stuff. So if you're buying a property today, we are in a good place because it's much harder to build new properties. Why? Because there's a labor shortage. 1/3 of the entire labor force for construction in the United States was undocumented. That labor force is gone at this point of time, so it's very hard to build. Construction costs have gone up because of both that labor cost and because of tariffs. But on the good side, bonus depreciation has come back. So Trump has brought back bonus depreciation, which essentially means that when you buy a building, especially a large building, this doesn't work so well when you're buying a single family, but if you're buying a 10 unit or a 100 unit building, now you have bonus depreciation. That bonus depreciation means that you can have huge tax benefits in year one, as opposed to waiting 25 years for your benefits. So massive, massive, massive benefits from Trumponomics. So on average, I think that, obviously Trump is a real estate developer. So on par, they're doing pretty well with what they're doing with real estate. This one's interesting because this chart was created before the Iran war started. And, mortgages, obviously mortgage rates support the single family and the multifamily real estate industry. The opinion was that the median is going to be 6.3. Now, because of the war, that number might actually be a little bit higher. So we might see interest rates around 6.4 for average for the year, or maybe even 6.5. This chart was also created before the Iran war, and the prediction was that home prices in the US will keep climbing. And the median prediction was a 1.5% increase. Just so you know, that's no longer true. So we are now seeing home prices in the US slow down and start to decline. So there are many markets in the US at this point of time that have gone negative in the last 6 months. This chart here only shows, bigger pockets predictions of, a couple markets being negative, but now we're seeing Texas and a number of other markets also go negative for home price growth. So the markets shifted because of the Iran war quite a bit. And it will continue to shift. This next graph is so CRE. So I really want you to pay attention to this next slide. Notice that until 2021, until right here, the actual median income in the United States, right here, and the qualifying income to buy a median home were sort of in sync, right? So you see them, they were in sync. But starting from here, we broke things in America. Things broke, no one noticed. That's really terrible because today the qualifying income to afford the typical home in America is $121,000. But the median household income in America is $84,000. So there is this ridiculous, shockingly large $37,000 shortfall. This gap has opened up just in the last 4.5 years, and it's not getting any better. There's also this thing called the lock-in effect. It's worth mentioning. Homeowners with ultra low mortgage rates, like me, I'm at 1.75%, are not moving, and that's keeping inventory tight. The lock-in effect happens when homeowners are reluctant to sell because their current mortgage is far cheaper than what they get in today's market, right? The result is fewer homes for sale, less price competition, and some upward pressure on home values. And for renters, this means that rental demand will stay strong because buyers are struggling for affordability. Home prices should be going down, interest rates have gone up, Home prices should be down $100,000, $150,000, but they are not going down because of the lock-in effect, which means that it's very, very difficult for new Generation Zs and Generation Xers to buy homes. They're too expensive for them, and their incomes, we showed you that in the last slide, are not matching up. And so now you have a new generation in America called forever renters. And these forever renters just can't make up the gap, right? So the gray line here is the median monthly mortgage in the United States, median monthly mortgage payment, $3,066. The blue line is the median multifamily rent, $1,880, right? And once again, if you notice, until 2021, these lines were tracking. But what the F happens after COVID, right? At this point, the gap between mortgage payments up here and mortgage and rents just goes crazy. It's incredibly large, right? If any one of you, 78 of you listening to me, tell me after looking at this graph that you can't figure out why you should be a landlord, I have to send you a free pack of Ritalin because you need it, right? The affordability gap here on the screen is astonishing. We've never seen anything like this in US history. These renters are forever renters. And if that last slide was not enough to convince you that you should be a landlord in some way, this next one will. As interest rates spiked, it became very difficult to build anything in America, especially to build apartments. As you can see, there has been a stunning decline in multifamily starts of 72%. This is based on permits being pulled. So if we continue to underbuild apartments, then at some point in the future, let's call it 2028, right, you're going to see very strong rent growth. It's inevitable. Nobody knows when exactly it's going to happen, but it's inevitable that we see strong rent growth if we don't build more apartments. We overbuilt apartments here, and now we're underbuilding them. Overbuild, underbuild. So with that record gap that I showed you between buying and renting and multifamily permits down from peak, you'd think that every market would be doing awesome with rents. Well, for the moment, they're not. And the reason is that supply headwind. Remember, I told you we overbuilt in 2023, 24, and 25? Well, that overbuilding, that supply headwind is still being absorbed. So right now, rent growth, especially in the Sun Belt oversupply markets, there's still supply pressure, and that's the opportunity. Because there is supply pressure, rents are not going up. Because interest rates went up, prices of multifamilies went down 25 to 30%, 25 to 30% cheaper. And because rent growth isn't there, you're not paying much. Because when you buy a multifamily, you're buying a business. When you're buying that business, guess what you're doing? You're paying based on net operating income. And right now, net operating incomes are incredibly low, right? So these properties are all underpriced because they can't project rent growth. And so whoever's buying them is basically buying them at rock bottom prices, 30% lower than before. That's stunning for an asset class that's considered one of the best in the United States. We have one more year of supply pressure and leasing concessions, and that's this year, 2026, and we're halfway through that year. And you can see that even with all of that supply pressure, so many markets are seeing positive rent growth. Now, these are the markets with negative rent growth. These are the markets with supply pressure. Otherwise, multifamily is continuing to do really well, and rents are going up. And rent forecasts are strong for 2026 in most markets. You can see Phoenix and Austin are definitely down markets. But for 2027, it's even better. So now the recovery is starting. Prices have dropped 30%. Rents have dropped in many markets by as much as 10%. And now the early signals are lining up before the crowd starts to return. We've not had a crowd in this asset space for a long time, right? So there are some of you that understand what cap rates are. So this is a technical slide. If you don't get it, you can zoom out, zone out for the next few seconds. When cap rates go up, prices go down. Cap rates up, prices go down. And cap rates have been going up, right? So as you can see here in 2022, cap rates dropped to an all-time low, all-time high prices, right? Now there's been an increase of about 130 basis points or 1.3%. And that means apartments are 20 to 30% cheaper, because 130 basis point move roughly means a 25 to 30% discount. There's a debt hangover as well. Some of you have heard about this, but that's nearly over. So when you look at overall delinquency, the only delinquency that we are worried about is for offices. As you know, COVID changed things, and now there's this concept of working from home. right? And people are working from home 2 or 3 days a week, and that means that we need less offices. So the scary line, the one that's really, should worry people, is the delinquency rates for office. They were already very high, and now they're continuing to go upwards. But when you look at all of the other asset classes, the delinquency rates are tight. By the way, they were double or triple this number in 2010, in case you want to compare. And so the rates are pretty normal. They're in the sixes, and that debt hangover that multifamily had from 2022 is nearly over. By the end of 2027 would be completely over. So now smart money is moving back in. Smart money has not been in apartments for the last 3 years. It's, total purchases of apartments are down somewhere between 50 and 70%. So if we were buying $100 billion worth of apartments, right now we're buying 30 or something like that. Now smart money is moving in because we have a chance for rates to fall with the war over and a president that is obsessed with lower rates, absolutely obsessed. I don't know if it's good for the economy, bad for the economy. I'm not an economist, but I know that Trump wants lower rates. So over the next 18 months, we should see rates fall. Not maybe over the next 3 months. I'm not talking short term. When you buy multifamily, you buy it for a 3 to 5 year time frame. When you build multifamily, you build it for a 3-year time frame. So you've got to look 3 years out. And I know that rates may not fall this year, but they're going to fall because you have a president that's going to take advantage of anything. The cycle is already reset. Prices were hideously expensive in 2022. Now they're very reasonable, right? I mean, even Warren Buffett is buying builder companies because they're so cheap. Because less people are building, so builder companies are cheap. So Warren Buffett just bought a huge multi-billion-dollar builder company, and no one tracks trends better than Warren Buffett, the greatest investor of all time. Supply is collapsing. Today, we're building in certain markets. I'll give you an example. San Antonio, permits are down 90%. And San Antonio has great population growth, great job growth, great income growth. The only reason permits are down 90% is because prices are down so low that it can't justify new construction in San Antonio. And because of that, 2 years, 3 years from now, we'll get great rent growth in San Antonio. I proved it to you that renting wins today. Generation X, Generation Y just can't afford to buy single family homes. There's a $37,000 income gap. So you've got 54 million Americans that are now forever renters. And now capital is beginning to come back. NOI, net operating income, is really cheap right now. When we're buying, it's going to be expensive in the future, 2 or 3 years down. So the cycle is already here and you can benefit from it now. Always buy when things are cheap. Multifamily is cheap right now. All right, so we finish our presentations with this thing called a shootout, right? So it's a market shootout where we talk about different markets and why we're interested in different markets. But before I go into that, I'm going to tell you about something that we are doing on a project. So we gave you those numbers at the very beginning, 9 exits, 40% annualized on those exits, 40% annualized. We're managing $350 million of investor money. 1,300 people have given us their money. This particular project already has 40 plus investors. We are building, right? We're building right now. It's been impossible to build new multifamily projects right now. This one's an exception. What you're seeing on the screen is not a rendering, it's real. This is the real building, recently completed, photos from a few weeks ago. Now we're building phase 2 next to it, right? And we're excited because phase 1 taught us a ton. That learning makes phase 2 faster, lower risk, cheaper, and ultimately more profitable. We're very excited to show this to you. It's not just the fact that Idaho Falls is a lower cost market, it's also a growth market. Not great, incredible. Jobs are up 18% over the last 5 years. Wages are up close to 50% over 5 years. What market has wages going up 50%? GDP growth is also very strong. The city has ranked near the top nationally for best performing small cities multiple times, and population growth has been incredibly strong. The point here, look at all of these numbers. Point here is simple. Low costs are great, but you still need outstanding demand, and this market has both. And it's uniquely positioned because of INL, Idaho National Labs. It's 9 minutes from our property. INL is the nation's #1 research for nuclear. And in most cases, it's the only certification hub for new nuclear reactor designs. And that's a huge deal because of AI. Every company is buying nuclear reactors. Microsoft bought one, Facebook bought one, Google is buying one, Google's actually buying 2, I think. Everyone wants more nuclear for AI. and INL has 6,400 very high paying jobs. It's growing intensely fast. That has a $1 billion impact on the local Idaho Falls economy. About 52 nuclear reactors have been built or operated from this one site on the screen. And on top of that, it creates a massive number of indirect jobs across the region. And that's why Idaho Falls is seeing incredible growth from nuclear. And it's not just the city that's strong. The neighborhood that we are around our project is incredible. Massive population growth, one of the highest in the country. Massive wage growth, over 7% a year. Projected home value growth over the next 3 years is amongst the highest in the nation. Unemployment, almost zero. Over half the jobs are professional and office-based. So this is a strong white-collar area. So here's a video of what the phase 1 project looks like. Real footage, real product, high-velocity, mid-market product for middle Americans. This is not a concept. It's not a drawing. It's what we build. Tenants are living in it, dozens of them. We have 28 5-star reviews this year. And this is why what we're building, phase 2, is de-risked. Here are some pictures of the product. And you'll notice something. There's different kinds of townhomes. These pictures, this one, and this one are one type. And then you've got other types here. We did all of this on purpose. We built different products so we could see what tenants actually want in the real market. Here's a look at the inside of one of these units. Brand new product, not a rendering. This is what the Fiona townhomes look like. This is what tenants are paying for today, and they're paying only $2,000 a month for a 3-bedroom, 2.5 bath, 2-level townhome with 9-foot ceilings, granite countertops. $2,000, super profitable for us. Let that sink in. All right. So on this slide, you can see the unit types lined up from least popular to most popular in phase 1, right? And you can see underneath the cost to build per square foot. And here's what's surprising. The product that leases the fastest and commands the highest rent is also the cheapest to build, around $90 per gross square foot. So the winner, highest velocity, highest rent, is also the most efficient to build on a per square foot basis. That's not luck. We tested multiple designs over the last 4 years in the real market, and now we're scaling this one, the one that wins. And in phase 2, we're building 75 more of those townhomes. Same product, bigger porches, 75 units, 1,900 square feet gross, 1,600 square feet net, 16 buildings total that'll be right here, including a beautiful clubhouse. High density, 5 acres of land, 16 to 17 months to build. Here's the layout. This is our existing community, which is 100% complete. This is phase 2 right here. Here's a beautiful clubhouse and outdoor amenities that will be built over the next 9 months. Clean, modern seating, large pergola, grills. This is an ultra fast project because we're replicating, right? We build in phases. Every time we build, finish 2 or 3 buildings, we lease them up. We did that in phase 1. In fact, phase 1 was 60% leased before it was complete. Before it was built, phase 1 was 60% leased, right? So each group, we build them, we fill them, we build them, we fill them. So it's extremely fast for a construction project. And the bottom line, we absolutely adore the project. We've had no projects for 2 years because we couldn't make the numbers work. This one works because Idaho Falls has insane grade. Phase 1 success is proven. We're using the same playbook. Entitlement risk, 0. Roads and utilities, already built. This is the lowest construction cost we've seen nationally in 17 markets that we've built in. Very quick path to construction and lease up, so cash flow next year. We've unlocked an institutional scale by combining phase 1 and phase 2 with a clubhouse, so we get better bank terms. And at 168 units, we unlock operational scale with a clubhouse, with on-site maintenance, on-site leasing. All of that supports higher rents. So if you're interested, please look at this project. We think that it's going to do phenomenally well. You book a call with Peter. He can give you numbers. We promise you they're very attractive. So here's your, and do we have a poll for this particular?
Yes, we do.
Okay.
I'm going to throw it up right now.
We're going to have a poll that we're going to throw up so that you can basically tell us if you're interested in Equinox on LinkedIn. Again, we don't chase you. We're not, heavy on the sales side. We'll give you information. Let us know. I think you'll find it interesting just to learn more about it and talk with Peter about it.
I will also put a link to the investor kit into the chat.
Yep. So, if you're in, but if you're not ready for Equinox on Lincoln Phase 2. I don't know why, timing's great. But if you're not ready, then you can join our investor club. So on the screen is the investor club. It's free, by the way. It's completely free. You can join it and you get 8 webinars like this one. Hopefully you enjoyed this webinar. You like the insights. We do 8 webinars like this about different things in real estate, single family, multifamily, Airbnb, commercial, industrial, hotels, things like that. There are different webinars every year and they're always free. You just have to join our club. And again, there's no upsell on the club itself. There's no subscription. It's meant to be a Wikipedia style community for everybody. So if you're interested, please join the club. All right. We'll finish off this webinar with a 2026 market shootout. I'll give you, now that 6 months have passed, I'll give you my sense of how the markets are actually doing. We always start the shootout with U-Haul. I've been showing this slide for the last 11 years, and the winner this year was not surprising. It was Texas, which jumped up a spot. Florida jumped up from number 4 to number 2. North Carolina, stayed at 3, and Tennessee bumped up a spot. But South Carolina actually went down surprisingly from number 1 to number 5. My personal favorite is down here, Idaho, which went up from number 10 to 8. Also interesting to see Alabama jump into the top 10 because we've never seen it in there before. These are the states in the U-Haul, those are the states. What about the cities? So no surprises here. The top 3 cities are the big cities in Texas, and they're there simply because they're so big, right? Most of these cities have been in this list for a while, but it's nice to see Charleston, South Carolina come in. The big surprise here is McAllen, Texas. It seems to be benefiting from its closeness to Mexico. We're trying to move away from China and move closer to Mexico in terms of, industrial. So we're doing a lot more business with Mexico these days, and McAllen is on that freeway that goes to Mexico. Now, my favorite annual report is the Milken Institute report. Each year they rank cities in the US for real estate investment, and they do a great job of it. And this year, their best performing large city is not a city. It's a cluster of cities in Northwest Arkansas, Bentonville, Rogers, Fayetteville. All part of this amazing cluster of 500,000 people, which is just doing everything right. I highly, highly recommend that you look at Northeast Arkansas for your real estate investments. Now, Huntsville is also pretty often, but it has a huge amount of supply, so wait for a year. The other cities that we constantly see in the top 10 best performing cities every year are Boise, Raleigh, Provo, Salt Lake. They show up a bit. Now, except for Boise, the other 3 are suffering right now. They have a lot of supply, so you might have to wait for a year to go into the other 3, but Boise's ready if you want to go in there. All right, those were large cities, but what about small cities? That's where the money is. Often smaller cities have better cash flow and less competition. I'm very proud to see St. George, Utah at the top of the list. We have a beautiful community that we built there of 118 apartments, 97% occupied. I'm even more proud to see Idaho Falls at number 2. It's been a winner twice in the last 5 years, and it has more projects by us than any other market in the US. Pocatello is at number 5. It's only 40 miles from Idaho Falls. Logan is at number 8, is about 80 miles from Idaho Falls. So I'm very impressed right now with this corridor of growth that goes all the way from Provo in Utah, up to Salt Lake, up to Ogden, then to Logan, then to Pocatello, and then to Idaho Falls, ending in Rexburg. So this is a corridor that's 200 miles long, and I think savvy investors should really, really take a look at that corridor. All right. Moving on from Milken Institute, let's take a look at top rankings from Realtor.com. And the winner in a number of different rankings this year is Hartford, Connecticut. It comes up a great deal. To be honest, I don't know a huge amount about it, but it seems at the top of every list, so something good is happening there. In previous years, you may have also heard me talk about Grand Rapids, Michigan, and it shows up at number 7. I don't like all of these. I tend to point out the ones that come back every year. That was single family. But what about multifamily? What about apartments? Well, San Jose is doing really well because of the AI boom. So is San Francisco. But these are expensive markets. Amongst the more reasonably priced markets, I want to draw your attention to Indianapolis at number 5 and Philadelphia at number 6. Those 2 are very interesting markets, and we've been tracking them for a while. I'm particularly impressed with the northern part of Indianapolis. All right. Done with our city lists, and it is a long-standing tradition, 12-year-old tradition, to finish this presentation with me sticking my neck out, making 2 predictions. I picked the best up-and-coming market in the US, Those are usually smaller markets that I think have a lot of potential. And then I pick what I consider to be the best market for real estate investment in 2026/2027. So are you ready? My pick for best up and coming market is Philadelphia. Philly used to be one of the three biggest cities in America at some point. This amazing metro has so much potential. Only now is it finally beginning to move in the right direction and live up to that potential. Yes, it is bureaucratic, and that's something that you have to live with. But there's a lot of good stuff going on in Philly. So check out this best up and coming market. And now for our best market of the year. And our best market of the year is Northwest Arkansas. So we picked this market in early January. The Milken report came out in February. And you might say, Neal, you just picked it from the report. Yeah, but we presented this to 500 people a month before the Milken report. We have a project in Northwest Arkansas. There's so much happening there. America's richest family are the Waltons. They live here. As they get older, they're becoming more and more philanthropic, right? So Walmart itself is continuing to grow. And they've become now the first traditional retailer to be worth $1 trillion. So that's 1,000 billion. Walmart is headquartered in Northwest Arkansas, and they are continuously expanding and growing in this area. There are a lot of other great businesses here too. So it's a very scenic market. It's a very young population, very trendy. Just about everything is going right for the area. So check it out. It's definitely worth a quick trip from wherever you are. And that's our show today, folks. Hope you liked it. We have a data-driven approach. What you learned today is a tiny fraction of the incredible and free knowledge that's available on multifamilyu.com/club. Many different speakers. We're planning 8 webinars in a year, so keep coming. And if you really want to benefit from the bottom of the market, bottom of the commercial market, take a look at that Idaho Falls project. It's absolutely a fantastic project. It's phase 2. We know exactly what we're doing. Same property manager, same builder, same bank, same team, just adding to an existing successful community where the Fiona units have been an enormous success. We can't even keep them in stock in winter, let alone in summer. So terrific, terrific opportunity. Peter can tell you more about it. And remember, we've succeeded in Idaho Falls tremendously. So it's not our first project there. It's not our second one either. We truly understand the market. If not, keep coming to Investor Club. And now I will open it up for your questions. Pete?
Great. Thanks, Neal. We have a nice roster of questions. Thank you everyone for submitting them. Just real quick, some positive comments. This chat is amazing. Pure data. Thank you so much for explaining and sharing it. So thank you for those positive comments there. Will we receive a PDF of this slide presentation?
Of course you will. Yep. But it might not happen tomorrow. It might be day after.
Okay, here's a question from Kelly. Can you discuss bonus depreciation more?
So there's a concept of depreciation. Depreciation basically means that you get to take, let's say you have a property that's worth $400,000. Let's say the land is worth $50,000. So now the rest of the property, not the land, is depreciable. So you buy it for $350,000, and over 27 years, you basically depreciate it to that portion down to almost zero, not quite zero, but almost zero. So essentially, you're taking $350,000 or close of losses. These are paper losses. The property actually goes up in value. By the time you sell it in 27 years, that $350,000 property is probably worth $1 million, right? But you, from a paper loss perspective, have depreciated that $350,000. The problem is, you basically have to hold on to it for 27 years to depreciate it. But you don't have to do that any longer, because the big beautiful bill allowed you to have massive amounts of that depreciation. Not all of it, not all of that 27 years worth of depreciation, but a massive chunk of it in year 1. So you can buy a property and take a huge loss. Now, property could be cash flowing and giving you money. These are paper losses. These are accounting losses. And that's what bonus depreciation is. It's freaking mind blowing. You can buy a $30 million building and have $6 million worth of investors in it. And basically in year 1, whether you're building it or buying it, doesn't really matter, same concept. In year 1, you might give them $4 million in losses. They basically invested $6 million, got $4 million in paper losses that they can apply to their other income. And that's awesome, because the property itself is not losing money. It might even be making money. They might still be getting distributions, but they're getting these paper losses. And because of bonus depreciation, they're getting a massive chunk of them upfront.
Thanks, Neal. That was helpful. What is your fee structure?
Very typical. I think that if you're buying a property, we'll charge an acquisition fee. If we're building a property, we'll charge a development fee. There's usually some sort of fee, sometimes given to a third party to sign on the loans, and an asset management fee. It's very standard. So the industry has a certain standard. There's thousands of companies that have the same fee structure as us. So it's not any uniquely different. We do share in the profits, but you guys get what is known as a preferential treatment. So if the project doesn't do well, we wouldn't make any profits. You would.
And when we show our returns, they're always net of fees.
Yes, always net of fees.
Question here about your data sources. Where do you pull this data from for your presentations?
I attend about 2 to 3 webinars a week from other sources, so I pull data from there. I have an AI agent called Hermes agent, which runs 24 hours a day. I've given it about 50 different data sources, so it goes there, it subscribes to that data, and it pulls the data into tables and then shares the data with me. I read it all on Saturday for about 3 to 4 hours, and then I pick the things that I want to do, and I share it with my PowerPoint designer, who, as you can tell, is very good at visualizing it.
What are your thoughts on multifamily in general in the Los Angeles metro?
Very expensive market, but very robust. I don't think, Los Angeles is going anywhere, but that's both a positive and a negative comment. I think it's a great metro. It will stay a great metro. I think the cap rates will stay low. It's just not a very profitable market, and I think you can do better. If you live there and you want to invest there, that's fine. But if you don't live there, why would you want to invest in Los Angeles? There's no cash flow. I mean, most properties that you buy in LA, let's say you buy 10 properties, 9 are going to bleed for the first 5 years.
How are you sourcing deals at rock bottom? For marketed processes, I am still seeing unrealistic asking prices.
I think those unrealistic asking prices are based on the assumption that the market won't go back up in the next 3 years. That's the honest thing. If you believe that the market will not go up, they're unrealistic. But markets always move in cycles. When the market was going down over the last 3 years, when going down 20, 25, 30% from peak, you weren't complaining, were you? In the same way, markets go back up. The biggest reason the market will go up is not because the prices have declined. That's not the biggest reason. The biggest reason is that there won't be a lot of supply of new construction in the 27, 28, and 29 years. Maybe not 26, but 27, 28, 29 don't have a lot of supply. And that's a reason why the market will go up. If you don't believe that, yes, it's overpriced. If you believe that, then I don't think it can be considered overpriced.
Question on the Idaho Falls opportunity. Who is managing the property?
A local property manager, so they're based there. In fact, of our 12 property managers, they're currently ranked #1. As you can imagine, we use AI, we rank all of our properties. We have a dashboard, it's very beautiful, very graphical. It's called, Portfolio Overview. And in Portfolio Overview, of our 12 property managers, currently Mecca PM in Idaho Falls is ranked #1.
I have access to CoStar and I'm looking for cities and markets to invest in multifamily in the Carolinas. How would you rank the cities using CoStar data? And are there certain submarkets that you like best in the Carolinas?
Yeah. #1 rank would be Raleigh. Second one would be, Charlotte, and then I can go and look at Winston-Salem. There's also that city near the coast. For the moment,
Wilmington?
I'm Wilmington. Thank you. So I'd probably give, Winston-Salem 3 and Wilmington 4. The problem with Wilmington is because it's so near the coast, the insurance is very high, so the operating expenses become problematic in Wilmington. Raleigh, I definitely like the best. The markets that I like in Raleigh are the ones that basically are very heavily tech enabled. So for the moment, I can't think of them, but it's not Raleigh, it's like CRE. Like, the cities around Raleigh that are tech enabled are really where you get the best bang for the buck. So look those up in CoStar, and you'll notice, by the way, if you look them up, those markets like CRE, the rents are much higher. They're $500, $600, $700 higher than Raleigh, and it makes it easier to make numbers work.
What are your insights and feedback on multifamily investment forecasts and market predictions for the Sacramento area?
Um, Decent market. I think that job growth recently has been anemic, so I'm a little worried about Sacramento because, it needs to produce more jobs, and right now there's just not a huge number of government jobs. So keep an eye on job growth, but otherwise a pretty decent market. Like there was this other person that asked questions about Los Angeles. I would definitely pick Sacramento over Los Angeles.
Regarding the Idaho Falls opportunity, what are the risks? How can I lose money? Is there a waterfall split? And what is the debt to equity ratio?
So I think that a lot of these are questions where you should have conversations with Pete.
Mhm.
The answer is every investment has risk, right? At no point are Peter and I going to tell you you couldn't lose money because you could, right? None of our projects has lost money yet, but they could lose money in the future. We're certainly not the kind of people that tell you that we are magical in any way. We're not. Point is, the risks are reduced because over the last 2 or 3 years, 70 investors put their money at greater risk into uncharted territories, into new kinds of townhomes, built them, leased them up. Now we have the information from them, and we're just basically building another 75 units next to, and just read the reviews. Type in Equinox at Lincoln, Idaho Falls. Read the reviews. They're all from this year, 28 five-star reviews. Tenants love what we have built. So I think that reduces the risk. Could we lose money? Well, yeah, sure. It's the usual stuff. Idaho Falls could crash. Its economy could crash. Our construction costs could go completely crazy because Trump tomorrow decides to triple, tariffs. Those kinds of things. We don't have an ICE issue in Idaho Falls. It's a very Mormon community, so not a lot of undocumented folks there. So that's not a risk. But all the other risks are there. Every risk that I talked about today applies to Idaho Falls. It's just the market itself is so robust that those risks are mitigated. And our project has done so well in the phase one that those risks are mitigated. Otherwise, the same risks that I've been talking about. It's not magical.
Okay, Neil, I think that is it for the Q&A. So I can turn it back to you for closing remarks.
Thank you. Um, Data beats gut feel by a million miles. Data beats gut feel by a million miles. And in the world of AI, we have access to incredible amounts of data. I was telling my son day before yesterday that the things that people used to pay $25,000 a year for are available today for a $25 subscription. And shame on you for paying those $25. You could just talk to Claude or ChatGPT for a few hours and get better information. That's the world that we live in today. And somehow people are still not using data. And that's our advantage. I hope they continue not using data. So thank you all for your time, and hopefully we'll talk with you more and have a chance to work together.
Right. Thank you, everyone. Have a great rest of your afternoon.